Hey traders, Gavin McMaster here from Options Trading IQ doing a video collaboration with Bar Chart. And today we're going to be looking at options strategies for earnings season. Before we start, just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So earnings season presents a unique opportunity for options traders. Implied volatility rises in the lead up to an earnings announcement, and options are an excellent tool for capitalizing on this volatility. In this video, we'll walk through some option strategies specifically designed for earnings season. The first strategy we'll look at is cash secured puts. Selling cash secured puts before an earnings announcement can be an attractive strategy due to the high implied volatility. High IV inflates the premiums on options, which means you can collect a larger upfront premium when selling puts. However, this approach comes with added risk, as earnings announcements can potentially lead to sharp price drops. This could result in the put being assigned. For investors who are comfortable buying the stock at the strike price, cash secured puts can be a great strategy for earnings. Let's look at some examples. So if we go over to our naked put screener at Bar Chart, these are our default parameters. I'm just going to add in one for symbol. We've got some big earnings coming up later in the week, and I want to specifically look at strategies for Apple options. I'm going to select weekly options, and I'm just going to look for options expiring in the next 15 days. So I'm looking at to take advantage of the high IV on those options that are expiring soon after earnings. I'll keep all the other parameters more or less the same. And here we've got our results. And I want to filter or sort by the out of the money probability. I want to have the furthest away from the money options. We could have also sorted by moneyness if we wanted. And here we can see the November 8th expiration 225 strike. So that's about 3.7% out of the money, trading at about $2. And that's going to provide a potential return of just under 1% in about 10 days or so, which is an annual return of about 33%. So that's pretty good. I'm pretty happy with that strike. Now, I will be on the hook to buy 100 shares of Apple at 225 if it does drop below that strike price on or before the expiration date, so I need to be aware of that. But I'm pretty happy owning Apple at that price, and if the stock does drop, I'll take ownership and I'll start selling covered calls against that 100 shares. If I wanted to be a bit more aggressive, I could go with one of the options that are closest to in the money. So the 230 strike for either the November 1st or November 8th expiration. We've got the same out of the money percentage, but our annualized return is a lot higher in this example because we're trading a much shorter time frame option. So you can see the premium's a little bit lower at 250 compared to 365, which means our net return is a little bit lower, but on an annualized basis, that's a very, very high return. So I'd potentially be looking at this strategy, this strike price, if I was quite aggressive on Apple. If I wanted to be a little bit more conservative, I'd go with the 225 strike for the November 8th expiration. Going November 8th as well just gives us a little bit more time to adjust the trade if needed. Let's say Apple does drop and comes down towards 225. I can potentially buy this put back, roll it out to a future date, and maybe roll the strike price down as well. The second strategy we'll look at is bull put spreads. Bull put spreads also take advantage of high implied volatility, but in a risk-defined way. Traders will sell an out-of-the-money put to generate premium, and then buy a cheaper out-of-the-money put as protection. Let's look at some examples. So this time we're going to use our bull put spread screener. I'm going to do some similar adjustments. Need to add the symbol and then put Apple. And I'm going to go short term as well, just expiring in the next 15 days. I'll select weekly options. And I'm actually going to filter here. I want an out of the money probability of above 75%. And if I sort by out of the money probability, that's quite a high probability, 95%, but the max profit is quite low. Typically with a bull put spread, I want to look for about a 10% profit potential. So I'm actually going to just come back here to the filters and add max profit percentage. And I want something above 10% and probably below about 20%. I don't want too high because otherwise it's going to be too close to the stock price. So here we go, perfect. Looking at some examples here. I really like this one. 80% probability of expiring out of the money and just over a 10% return in a pretty short space of time. Again, November 8th expiration. Our short strike's actually a little bit lower here at 222.5. So I quite like the look of this one. If you wanted to go a little bit more aggressive, you'd choose one with the 225 strike and a slightly higher max profit. But this is a great way using the screeners to just filter down to a couple of potential candidates for our bulls put spreads trades for Apple earnings. The last strategy we're going to look at is calendar spreads. And volatility skew is most severe right before earnings, and calendar spreads look to capitalize on that skew. A calendar spread involves selling a short-term option and buying a longer-term option. The trade is placed for a debit, but still aims to make money through time decay and changes in IV. Let's look at some examples. First, I just want to highlight a new feature at bar chart, which is really cool and really valuable when it comes to earnings, and that's the volatility term structure. It's available here under options volatility charts. And here we're looking at Amazon reporting earnings in a couple of days. And you can see here massive implied volatility in the weekly options that expire this Saturday. So 90% IV here. And as we go further out in time, the IV is dropping further down. So calendar spreads are perfect to take advantage of this situation where we're selling the short-term option with really high volatility and we're buying a longer-term option with the lower volatility. So if we go to our calendar spread screener, I'm going to try and find some calendar spread ideas for Amazon. We'll add our symbol again. And I'm going to say leg 1, I want to expire within the next 15 days. Leg 2 looks fine. And I'll just leave all the other parameters the same for now. And we'll see what sort of results we get. So we're getting 45 results. I might try and thin that down a little bit, either by filtering for the max profit probability or our net theta. So we'll say probability of max profit above 50%. And now we've got only 19 results. So that's looking pretty good. If we wanted to, we could filter or sort by the net theta as well and try to find something that has a really good max profit probability and some good net theta as well. So here's a really good candidate, potentially this one as well. So here we'd be looking at selling the 185 call for November 1st expiration and buying the 185 call for the main December monthly expiration. So that's going to cost about $445, and that's our maximum loss on the trade. The other idea would be to find something that's more at the money, which would more be the 190 strike, which the first couple of candidates here have a really good max profit still and really good net theta. So either of these would be a potential candidate as well. Both using the 190 strike, November 1st expiration is the short leg, and the long leg just changing between a early December expiration and the regular monthly December expiration. So this one's a little bit cheaper because the bought leg is a little bit shorter term. In conclusion, earnings season offers unique opportunities for option traders. Today you've learned how to find, analyze, and apply 3 different option strategies for earnings. If you enjoyed the video, please like, comment, and subscribe. Thanks for watching and have a great day.